Hello, and welcome to Nonprofit Financial Stewardship. My name is Eric Schwartz, and together with my co-instructor, Professor Honan, I'd like to welcome you to this year's course. Before we begin this pre-module, I thought it'd be important just to provide a little bit of background for why we're recording this module. Module 2 of Nonprofit Financial Stewardship is focused on understanding and reading not-for-profit financial statements. In prior years, we found that participants have come to the course with varying levels of comfort with respect to reading and understanding the information in those financial statements. As such, we've pre-recorded this module to serve as a primer for Module 2. If you're relatively new to reading not-for-profit financial statements, or perhaps feel like you just need a refresher before you enter that module, I do encourage you to participate and read through this module before we begin. This slide highlights the objectives that we'll cover in today's pre-module. First, we'll define not-for-profits and we'll distinguish them from for-profit organizations and governmental organizations. Secondly, we'll move into the accounting process. We'll look to understand the concepts and steps within the accounting process. Third, we'll talk a bit about the accounting principles and the concepts that govern the recording of thousands of transactions on a daily basis. We'll then move into financial statements, understanding the basic financial statements, and the key terms, and then we'll wrap up the course distinguishing between the cash and accrual basis of accounting. So let's get started. On this slide, we've clarified and distinguished for-profit entities from not-for-profit entities from governmental entities. Starting on the left, you can see that for-profit entities are owned by shareholders and they have a profit motivation to maximize the return for those shareholders. In contrast, not-for-profits do not have shareholders. The board serves as the fiduciary for the general public, and by virtue of being exempt from taxation, at least here in the United States, the job of not-for-profit organizations is to establish a mission, provide a service, and ensure the general public can monitor its performance in fulfilling that obligation. And then thirdly, governments, they levy taxes, they establish legislature, and laws. Three very different organizations with clearly different constituencies and different stakeholders. For purposes of this course, we'll focus on not-for-profit organizations. With respect to the financial statements for not-for-profit organizations, who are the users of this information? Well, you can see here on this slide we've outlined a number of different users of those statements. These could include grant funders or donors in looking to make a determination to fund a particular organization. It could be a bank or some other organization looking to lend money to a not-for-profit. The board uses the financial statements to assess management's performance and their skill. New employees may look at the financial statements before making a decision to accept a position. The general public is very much interested in understanding how a not-for-profit is fulfilling its mission to the public, and the government as well. Clearly a broad listing of users of the financial statements. Our job is to provide meaningful and timely and relevant information in the form of those financial statements to the users of those statements. What questions are these financial statement users asking? Is the organization financially viable? Very important question, and we'll discuss in more detail in future modules how financial statements are used to make that assessment. How is the organization spending its money? We'll see in modules 2 and 3 that an organization can spend its money perhaps on the program, on fundraising, or other administrative activities. Oftentimes, when users of the financial statements look at this information, they reach conclusions on how efficient the not-for-profit is operating. Can an organization pay its debt, or is the organization a good credit risk? Certainly a key question that a lender is looking to the financial statements to determine before being willing to lend money to an organization. Can an organization meet its payroll? Certainly a very important question for a current or prospective employee. And would it be prudent to make a contribution or a loan to this organization? Certainly, if a set of financial statements shows poor performance from both a profitability or liquidity perspective, a resource provider may second-guess themselves before providing such funding to the organization. Pretty high expectations for financial statements, and quite frankly, that's why the accounting profession, of which I'm a member, spends its time to provide reliable, transparent financial statements to the readers in order to answer these questions. Let's talk a little bit about the accounting process. You could spend semesters in school, in business school, covering this process, so believe me, we won't spend quite that long here in the pre-module. But if we start in the top right-hand corner, there are thousands of transactions recorded throughout the year. All of these transactions are then captured in accounting systems, and those systems are used to accumulate those transactions within the general ledger and the trial balance. The trial balance, a statement of account balances as of a point in time. The general ledger, oftentimes referred to as the GL, or the trial balance, the TB, are then organized and summarized to prepare the internal financial statements, such as an operating budget and other management reports that are used to monitor the business, as well as the external financial statements, which we'll discuss in further detail both in this pre-module and later during our course. So that's the right-hand side of the screen. What about the left-hand side? Here we've highlighted both accounting principles as well as accounting policies and procedures. In addition to the basic processing and summarization of transactions into the financial statements, there exists a standard set of accounting principles that govern the manner in which transactions should be accounted. We refer to that as GAAP, Generally Accepted Accounting Principles, and management will develop accounting policies and procedures in accordance with GAAP to help guide the organization in accounting for all of those transactions that take place throughout the year. Accounting principles help drive the reliability and comparability of financial statements from one organization to another, and in fact, the public relies on the accounting profession to conduct its audits and to opine as to whether a set of financial statements are fairly presented in accordance with GAAP. So who makes the rules for the financial statements, or GAAP as we refer to them as? On this slide, we've listed a number of different principles that currently exist. For our purpose, we refer to the Financial Accounting Standards Board as the primary standard setter for not-for-profits as well as for-profit organizations here in the United States. If you're a governmental organization, that standard setting board is the Governmental Accounting Standards Board, or GASB. If you're the federal government, the Federal Accounting Standards Advisory Board. Or if you're not based here in the United States, and you're thinking from an international perspective, it's the International Accounting Standards Board. And recently, the IASB is becoming a much larger force as organizations become more global. In fact, the FASB and the International Accounting Standards Board in recent years have taken steps towards the convergence of their standards, in particular as it relates to the accounting for revenue recognition and lease accounting. However, not-for-profit financial statements, for not-for-profits, FASB is still the primary standard setter, as the International Accounting Standards Board really has not yet fully addressed the unique nature of for-profit, not-for-profit reporting. In addition, and we'll touch upon this a little bit both in Module 2 and Module 3, in August of 2016, the FASB issued the first of two anticipated pronouncements that will have significant ramifications for how not-for-profit organizations present their financial statements. In particular, when you look at a set of financial statements and see three broad classifications of net assets, the FASB is now proposing to reduce that to two. And we'll go into this in a bit more detail, as I mentioned, in both Module 2 and Module 3. So let's talk about the basic framework for financial statements. What are some key concepts that go into a set of financial statements? First, a set of financial statements are for the entity. It's not for management and it's not for the board. Management's own personal net worth, the assets owned by the individual employees of an organization, liabilities that are owed by the employees of an organization are not captured in a set of financial statements. The financial statements just represent the assets, liabilities, the revenues and expenses of the entity itself. Secondly, financial statements assume that the organization is a going concern. That is, it will continue to operate in business indefinitely. This is a very important concept in the accounting and the auditing profession because if an organization is not considered a going concern and there is a concern potentially of it going out of business, it does impact significantly the valuation of the assets and the presentation of the liabilities on the financial statements. Third, financial statements are measured in money, in currency. Cash, other assets, other liabilities, the items captured in a set of financial statements need to be denominated in a currency. Items such as the reputation of management, the value of the brand, or the quality of service that an organization provides, while very important, are not assets that are captured on the financial statements. And lastly, and we won't spend too much time on this, we refer to as the dual aspect of accounting. And for those accountants that are listening to this pre-module, you'll understand this to mean that debits always need to equal credits. This goes back thousands of years to the introduction of accounting, so therefore we won't spend a lot of time explaining why that is the case. But when you make an entry in the financial statements, it needs to balance, and if you're increasing one asset, the offsetting increase to another account or decrease needs to equal. These general concepts apply to all financial statements in all types of organizations in all countries. What are some drivers of these accounting principles? We talked about the standard setters, the FASB, GASB, and other organizations. What are they really focused on when they issue new pronouncements that are applicable to our organizations? Well, we've highlighted here on these 4 slides 4 key principles that they're focused on. First, comparability. Financial statements need to be comparable across organizations. A reader should be able to pick up the financial statements for one not-for-profit hospital located in Boston and feel comfortable that a transaction has been accounted for in substantially similar fashion as another not-for-profit hospital in Boston would account for that same transaction. That means comparability. Consistency refers to how information is presented from period to period. An user of the financial statements should be able to open the statements and feel comfortable that the way things are presented in 2016 is how they'll be presented in 2017 and how they were presented in 2015. You generally cannot change your accounting principles to get a more favorable presentation of your financial statements in one particular year. The third driver of accounting principles is conservatism. When there is more than one acceptable way to record a transaction, accountants generally will choose the more conservative of the 2 alternatives. When in doubt, less is better. You'd rather have an increase to an asset or additional revenue recognized in a second year as opposed to overly estimate something and then have to take a hit to your financial statements and recognize an expense down the road. And then lastly, and very importantly, is the concept of materiality. It would be cost prohibitive to do everything down to the last dollar and the last penny. Therefore, the focus is obviously given to those items that are material and would have the greatest impact to the users of the financial statements. So let's jump into the basic not-for-profit financial statements. On this slide, we've highlighted the 4 statements, the top 3 of which are typically referred to as the basic financial statements, and then the 4th one, which can either be presented within the footnotes or perhaps in a supplemental schedule to the footnotes, is also equally important. We'll cover each of these in much more detail on a later slide, but briefly, the statement of financial condition, also known as the balance sheet. The key equation there is assets equal your liabilities plus your net assets or your net worth. The difference between what you owe and what you own is your net worth or the net assets of the organization. The second statement, statement of activity, oftentimes referred to as the schedule of expenses and revenue, or perhaps the income statement, is presented for a particular period and shows the differences between your revenues and your expenses. The difference between your revenues and your expenses is the change in net assets. The format of this statement may vary from one industry to another, but the basic principle is always the same. The statement of activity or the income statement, very importantly though, under an accrual basis of accounting, does not measure liquidity. And that's why the statement of cash flows is very important to the users of the financial statements. The statement of cash flows presents how you've used your cash and how cash has come into the organization in any particular year. It will show the cash in and out from your operations. It will show the cash generated or spent from investing activities, as well as the cash from financing activities. When we refer to investing activities, that is, has the organization decided to invest its money in stocks and bonds, or perhaps invested in the capital and the plant of the organization? And when we refer to as financing, has the organization needed to borrow, or is it repaying existing borrowings? Oftentimes, when the cash from operations is not sufficient to generate cash inflow, the organization does need to turn to its investing and financing activities to generate cash flow. And then lastly, the functional expense statement. This is a measure of how efficient the organization is in spending its money and where it's spending its money. The total expenses that were presented on the statement of activity will be summarized in this statement in 3 categories: program expenses, fundraising expenses, and administrative expenses. The greater your administrative overhead, or the greater percentage of expenses that are paid for administrative purposes, could raise questions regarding the efficiency of the operations of the organization. And on the next several slides, as I mentioned, we'll dive into each of these statements. So let's talk about the balance sheet a little bit more. As I mentioned, the key equation, as you can see at the top, is assets equals liability plus net assets. That's that dual aspect of accounting that we mentioned earlier in this pre-module. It's a snapshot taken at one point in time, typically at the end of the fiscal year, but it could be measured at any other time for internal purposes. What are assets? Well, they're things of value that you own or that have future economic benefits for the organization. Could be your cash, your investments, inventory, fixed assets. These are examples of the assets of the organization. The liabilities, things you owe, debts and obligations to external lenders, could be obligations you owe your employees, perhaps pension, salaries that they've earned that you haven't paid yet, or maybe items that you owe to a vendor that's provided you service, such as accounts payable. Those are examples of liabilities. And then net assets, as the equation at the top will indicate, are the difference or the accumulated equity of the organization since inception. Net assets are called many different things for different companies or different individuals. You could refer to it as your net worth. The government refers to it as fund balance. For-profit companies refer to it as the equity. So let's take a look at a simplified balance sheet. Here we've presented the balance sheet of the American Sleep Apnea Association for 2015 as well as 2014. You'll see that it's presented as of a period of time, June 30th, at the end of both fiscal years. And in thinking of our key equation, total assets, which you can see in the middle of the page for June 30, 2015, were $61,658, which equal at the bottom of the page the same amount of total liabilities and total net assets. If you look at the captions within the page, you see total current assets as well as total current liabilities. Generally, assets are going to be presented in terms of how quickly they'll be converted to cash. Cash will always be presented first, and then as you work your way down the asset section of the balance sheet, you become less liquid. Generally, current assets are those assets that you would expect to see convertible to cash within a year, whereas your non-current assets, in this case property and equipment, will not be converted to cash within a year and are presented outside of the current asset caption. Within liabilities, you also see current liabilities. Current liabilities generally represent those items that will be converted or that you'll need to use cash for within the upcoming year. Your trade accounts payable, the accrued payroll that you owe to your employees, perhaps deferred membership dues. These are all items that you'll use cash to repay over the upcoming year. In this case, Sleep Apnea Association does not have any non-current liabilities, but if they did, they would be presented below current liabilities and before the net assets caption. And then we also talked about comparability. In this case, Sleep Apnea Association has presented 2 years' worth of financial statements. Generally speaking, not-for-profits will present 2 years of statements. For-profit organizations will present 3 years, but for most of our organizations, you'll see 2 years presented side by side.